Hey guys, Tommy Bryson here, and right now the stock market is down, but I'm always surprised that people get very worried when the market is down and they want to sell everything and they're just like, hey, I don't want to invest anything because the market is down. But in reality, it's the perfect time to invest more money because, hey, you're going to be buying things at a massive discount. And there's one big thing here, guys. If I told you, are you surprised whenever winter is cold or summer is hot? The answer is no. I know those things are going to happen. And whenever it comes to the stock market, we always have market cycles. Whenever the market goes up, and it goes down. And you also have the bull markets when the market is super hot, everyone is buying, things are going great. And then you have the bear market whenever the market is like down for an extended amount of time, usually 20% from its recent high or whatever. We have not hit that yet. So we're actually not in a bear market, even though you might hear, hey, we're in a bear market. Hey, this is very bad. We're actually not even in a bear market. That's not happening. We're just low. Things are not great, but things are not super terrible whatsoever. And there's one thing I learned growing up from like business and so on, and it's that you never ask a barber if you need a haircut. You will always need a haircut to a barber. Likewise, when you come on YouTube, because we are the new news in a sense, there's always going to be something negative about the stock market. Something else is happening. You're always going to have to keep up with everything, okay? But in reality, if you understand the market basics and how it works, you don't need to be constantly worried and have anxiety about whatever's going on with your investments. Because overall, we understand the markets have cycles, and it's just how things work. In this video, I'm going to tell you 3 ways to make money from the stock market when it's down, but I'm also going to tell you exactly how everything works. That way, you really concretely understand. That's the goal. And stick around all the way to the video because I have something else I want to tell you by the end of this video. Now, first things first, smash the like button and top that. Also, subscribe to the channel, hit the bell so you're notified, and let's get started with the very first way. Now, the thing you always hear the most is basically, if the market is down, well, you want to go ahead and invest money and buy the dip. That has to be one of the stupidest things I ever heard in my life because the dip, in reality, when you hear from 90% of the people out there, they just mean, hey, the market is down from its high point. So if you buy now, at some point it's going to come back up and you're basically going to make money. But in reality, that's not how the dip actually works, okay? And buying that way can really get you in trouble. It's kind of like, for example, I go to Walmart all the time to buy meat and so on. But if I find out that my favorite meat, my favorite cut of meat is at a 50% discount, I'm going to be very skeptical, obviously. But if I go ahead and I just buy that blindly because, hey, it's lower than it was yesterday, and I bring it home, it smells, and it says, hey, this thing's about to expire like in a few hours, I'm going to be worried because guess what? There's no one for me to sell these things to, right? Makes no sense. Same thing with buying the dip. If you're buying a stock, right, and it's basically, let's say 20% down from its original high or 50% down from its original high, in reality, are you really getting a discount if the stock itself is just a lousy company and is going to go bankrupt? The answer is no. You're not actually getting a discount whatsoever. So buying the dip blindly makes absolutely no sense. The only way to buy the dip is to understand what the true value of the company basically is. And when you buy below that, then you know, hey, I'm getting a discount. It's like if you're selling me a Gucci shirt, and I understand that these Gucci shirts go for in the market for $100 a pop on eBay or whatever, and you're selling to me for $50 because you need some extra cash. I know, hey, I'm buying this for basically a massive discount, right? 50% off basically. And even if it goes down in the retail market to $75 per shirt, like $75 per like Gucci shirt or whatever, I'm still gonna make a 25% profit, right? And that is, well, 50% profit. And that is awesome. So I buy because I know what the actual value of the item is. So don't just buy the dip blindly. It makes absolutely no sense. Now, how do you make money buying the dip blindly? Well, the only category of investors that can do that blindly and make money are the boring investors. And I include myself in that entire community because I am the founder, by the way. But you have the boring investors that basically, they're just investing into index funds. And they're investing into ETFs that track different indexes also. And the idea is that there's a benefit and there's also a con. The benefit is that because you're investing for the next 10, 20, 30, 40 years, the market is going to average things out. So whenever you have a market low and you're buying then and you're holding out for a very long time, it doesn't matter when it corrects, as you understand The past 50 years of data shows that the market always recovers, so you're going to be just fine. But the con is that this needs you to be super patient and understand you can't sell right away, and understand that this only makes sense as long as you're investing over the long run and allow the corrections to actually take place and allow the market to keep making you more money, and also keep investing more money very frequently. It's the only way you can do it blindly, because all of your investing is blindly based on the market averages of before. Now, to really send this point home, it's kind of like this, okay? The way I invest is whenever I get paid every single month, I deposit 20% of my money into my investment portfolio every month. Whether it's winter and it's super cold and the stocks are down, whether it's summer, the stocks are hot and everyone's like buying and the prices are up, I don't care. I'm buying every single month no matter what. But if there's a massive decline, I might buy some more at a discount. But I'm always buying. So I'm always getting the average, and every now and then I get to buy a dip, and that helps me out in the long term. That's the way it basically works. It's the only way to make money if you want to do it blindly, which is invest the boring way. It takes patience. You won't make super amounts of money. You'll make like 8 to 12%, but over the long term, that will be a lot of money, but you got to allow it to grow over the long term. Now, the second way to actually make money when you have a down market is going to be by shorting the market. And in a basic way, what you're saying is, I'm going to bet that the stock market is going to go down, okay? And if it does go down and I'm right, then I'm going to go ahead and I'm going to make money. Now, the simple way to understand this, the way it was broken down to me, imagine, for example, if me and you are neighbors, okay? And we live in this very nice neighborhood, and apparently I have a lawnmower 5000 and it cost me $1,000, okay? Now, I have this lawnmower and you want to borrow it. Okay, so you go ahead to my house, you borrow the lawnmower. I'm like, hey, here's my lawnmower. You grab my lawnmower, you sell it for $1,000, and you believe, because you got some news from China, that these are actually going to go down to $500 per lawnmower. Now, news comes back, they're actually down $500, but you already sold it for $1,000. So you go ahead and buy a replacement for me, same lawnmower 5000. You give it back to me, but you get to pocket $500. That is you shorting the market. You buy shares at a certain price and then you sell right away. And if it goes down, you get to go ahead and keep the split or keep the gap, keep the extra money in between. Now, obviously, the stock can go all the way to zero, right? Or my lawnmower can go all the way to zero. That way you buy it for nothing, basically, and then you give it back to me and you make all that money, all that profit. But the big problem with shorting is that it can also go up infinitely. And that's very scary, right? Because what if my lawnmower would have gone up to $2,000 or $5,000 or $10,000? Well, you would have had to find that money. So what if you buy a stock and you sell right away, right? And now the stock just keeps climbing and climbing and climbing. Obviously, you got to find the money and get out right away, because it can keep climbing and climbing and climbing forever. Like, you have stocks that are $400,000, $300,000, even 700, 500, 3,000. It can go all the way up and you never know. So the reason I don't like shorting the market as a way to make money, because you're basically trying to predict, which takes skill and also takes a lot of luck involved. You're basically saying, I think because of these reasons, the market's going to go down for an extended amount of time, but you have to be right. And the odds are you're not going to be right, okay? Usually not over a long period of time. And a lot of folks out there, they think they're very smart with this stuff, but history shows it's hard to be right when it takes luck, a lot of luck involved over a long period of time, because it's kind of like guessing. I think it's going to go down because of this, but you don't really know how the market is going to react. But I have one way that if you do want to do this like a, like an average person or so, that you want to kind of like hedge against the market in case it actually goes down and you want to make some money, the answer is you can always buy this investment right here. It's called SH. You can actually go ahead and find it. And what this investment does, it basically, it goes counter of the S&P 500. So whenever the market is basically going up, it goes down. Whenever the market is going down, it goes up. And here it is right here is ProShares short the S&P 500. You can find it right here in any of your investment brokerage apps. And the ticker symbol is actually SH, as you can see right there. But right now, it is positive, okay? It is making money because the stock market is basically down, so you get to make some money. Now, initially, a long time ago, actually, I thought about adding this to my portfolio and saying, well, I can just kind of put money into that like very frequently. So whenever you have a massive drop, I can always just like counter just to make sure I have some money on the side because I don't want to not have all that money. But then like it's not really my game. I don't want to get involved in shorting the market or anything like that. And since I'm doing it for the long term, it doesn't really matter that much. But if you do want to do that and you want to add it to your portfolio and say, hey, I want to have 10, 20% of my portfolio in here. So the market crashes by 20% or 30% over a long period of time, I can always go ahead and kind of cash out on that and make sure I have some money or whatever it is, okay? But that's a really easy way to make some money if you want to short the market without actually going ahead and shorting the market like the regular folks with individual positions and so on. Now, the third and final way to make money during a down market is by becoming a value investor. Now, a value investor, one of the most famous ones is actually Warren Buffett, which is back there on my table. That guy is my hero. I appreciate him a ton, and I talk about him all the time because he's helped me out a ton with his books, his messages, and also his wisdom. But overall, value investors are super weird because these are people that when the market is doing great and you have a bull market, remember, bull market is good, bear market is bad, okay? Just remember that. I don't know why exactly what the history is. I should look it up, right? But I don't know what it is. If you do know, comment down below like the history. Like why did they pick a bull? Why did they pick a bear? Okay, but overall, when you have a bull market, they don't look that great. They actually look like idiots because everyone's making money and they're not making that much money because in reality, they're not buying anything. Because whenever everybody's buying and everyone's making money, well, everything becomes very expensive and they don't buy when things are expensive. Now, whenever you have a bear market and the entire market is basically down, that's when they kind of come out and they're like, yeah, there's blood on the streets and we are going to go ahead and take advantage of everything here. That's what they kind of do, okay? And they buy securities or stocks at a very low price and they go ahead and that's where they bulk in all the profits. Now, here's the entire idea, okay? These are people, they usually buy companies or stocks that are out of favor, that are at an all-time low, and they go ahead and buy lower than they're actually worth. And it's not like they're buying terrible companies. They're buying good companies that are out of favor right now. It's kind of like, for example, a good example. Okay, I did this too. I did it back in 2020 when airlines were basically out of favor. No one thought, for some strange reasons, that the entire human race was going to get again on an airplane to go somewhere. Okay, which is very weird. But I went ahead and I bought Delta, a very good, solid company, which is a terrible investment in a sense. But at the time, I was buying at a steep discount. I was buying for like, I think like 50% less than it was actually worth. Crazy stuff. And then a year later, it recovered. And guess what? I made a lot of money. I made around 128% on that investment. Very easy money, quick money. You have a good company in a sense that went down out of favor because of economic stuff going on right now, but it's still a solid company. And when it recovers, I made a lot of money. So when I bought it, kind of looked like an idiot, right? But when I sold it, looked pretty smart because I was buying something that was worth less than it was actually worth. Now, this only makes sense, obviously, if you understand how to go ahead and value a company, to understand the balance sheet, the cash flow statements, the income statements, to read the 10K forms, the 10Q forms, to read the filings, the earnings, to understand, for example, the management, the company culture, to understand how the entire company basically works overall, to then make a great decision and say, hey, I'm going to buy this company for this price because I know it's at a discount because I know how to analyze all of this information. Now, one thing that I find very interesting is that basically most of the famous value investors, they all went to Columbia University. And I'm not surprised because I was also going to go to Columbia University at one point because I thought that, hey, that's where the best investor in history went, okay? And that's not just Warren Buffett, but it's actually Benjamin Graham. He taught there. So it's kind of like whoever's interested in investing goes there because they know that's where it all kind of started or whatever. So that's where people basically go there. But they all say the same thing. They all say that you could have done it without going there. So you can actually teach yourself how to become a value investor for like $200 or $20, okay? And I mean by buying books. So if you're interested in becoming a value investor, I'm going to recommend these two books, which I read and are very solid. But I have to say something. These books, they're for beginners. They're not for like, oh my god, you're gonna get so much out of this stuff. And you gotta understand that whatever worked then won't work today. And it's all about getting a good understanding overall to understand what you need to do and not to try to copy formulas, because formulas can become very dull and can expire and they don't work because everyone else uses them. Okay, strategies, they wear out. So overall, the first book is going to be called The Intelligent Investor by Benjamin Graham. And I think this is a great book because it teaches you exactly what the market basically is and how to control yourself, okay? Because the first thing when it comes to the stock market is to control your emotions, because if the market is high, you kind of want to invest and be a human like everybody else and kind of say, hey, I want to go crazy too. But when it's down, you have to kind of pull up your pants and say, hey, I'm going to invest into this company even though it's down, because I understand that the criteria is right. And that takes a lot of courage in a sense, okay? Now, the second book right here is actually one I actually love a lot, and I just finished this one a few days ago, and it's Value Investing from Graham to Buffett and Beyond. And it's actually from these professors right here. So you have Bruce. I mean, let me make it sure. Okay, there you go. You guys see it right there. Boom. And you have this book right here. Okay, it's a good book, and it kind of goes into detail with a few examples of how to analyze companies. For example, like WD-40, Intel, a few other ones, and it kind of shows you, hey, here's how you can actually calculate the value of a company, but it also gives you some profiles on other value investors. So if you want to learn, hey, who are other investors that are not just Warren Buffett, Charlie Munger, Peter Lynch, and so on, well, here's another list, okay? And I liked it a lot because it gives you a lot to pick from. And I actually found someone that kind of fits me a lot more than Warren Buffett does, because Warren Buffett just has a bunch of money and he can only kind of invest into big companies that are at a slight discount or selling for a fair value because there's so much money, okay? But yeah, that's basically it. Those are 3 ways to go ahead and make money from a down market. Now, if you made it all the way to this point of the video, then congratulations, because there's something that I want to tell you. And comment down below, value investing. That way I know you made it all the way down here, okay? That's the only way I'm going to know. Comment down below, value investing or value investor. Now, here's what I have to tell you, okay? Sometimes the juice is not worth the squeeze. Not every opportunity you have to take it. I always say the same thing. Before you start investing into stocks and all this stuff right here, I recommend you pay off your debt first, and you also have an emergency fund fully funded. Because the worst thing I ever see is people that kind of learn a few basics, they invest some money, and they might get lucky, they buy a stock at a great price, and all of a sudden they're making money, but then, for example, they have an emergency or something goes wrong and they have to sell that and take the money out, and that's not great. Or you make an investment, it's going down, 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 you need the money fast, so you kind of have to sell, and that's not great either. So when you take care of your debts, you take care of your emergency fund, you have stability in a sense. So whatever you actually do, you can do it on steady ground and not have to worry about selling your investments. That's something I learned from Peter Lynch myself, because he used to tell me all the time when I read his books, obviously, that he's a good investor, by the way, great investor. So all the time, Tommy, before you start investing, make sure you have a house. That's taken care of. So that way you're not operating from unstable ground and you're worried all the time. So focus first if you want to be a value investor on getting knowledge. Most people, you're going to be fine with just being like a boring investor like I am for now. That's what I am right now, honestly. But eventually, when I get into this, I want to be on steady ground. So that's why I bought the house first. I paid the debt off. I have an emergency account fully funded. And once you have those things taken care of, you can kind of say, okay, I can operate with the knowledge, with a steady foundation, control my emotions, and make good investments. That's all I have to tell you guys. Thanks for watching. As always, subscribe to the channel. Only around like 20% of you guys that watch the content are actually subscribed. So go ahead and subscribe right now. It's free, and you get content whenever I post it directly to you, like 3 times a week, about making money and so on. So why not? Thanks for watching. As always, like, subscribe, hit the bell to be notified. On top of that, here's my face or another video on investing. Watch this one. On top of up here is my face. This is my face. Yeah, this is definitely my face. Subscribe here, and thanks for watching, guys. As always, Long Term Team officially out.